Warren Ingram, of course, the co-founder of Galileo Capital, joining us tonight on The Money Show. Warren, good evening. It's, for you tonight, it's not about timing the market. It's all about time in the markets. That's how you believe you actually make money through investing.
It's a kind of almost a cliche, Stephen, but I'd call it a pearl of wisdom that's older than you and I. When we look at investing in markets, we kind of get tempted by big events, big news to make a rapid decision, either to buy into the stock market because things have been going up for quite some time and everyone's really positive, and we're sitting on the sidelines feeling that sense of FOMO, that fear of missing out, and so we decide to jump in, and that's usually the one big temptation. The other one is when markets have fallen and everyone's panicking, and the headlines are screaming at us that there's blood in the streets, and obviously that's not literal, that's proverbial, and it's time to get out because this is the end of the world. And Stephen, we had one of those episodes last week when the Japanese stock market fell 12% in a day, and that's one of the world's big markets taking a massive tumble, and it had a huge knock-on effect, all around the world, from Japan right through Europe into the US, and caused quite a lot of panic. And everyone forecasting that now the markets were really going to tank and everything was going to go over. And the next day, Japanese market jumps 10%, and we see kind of over the week some fairly decent news around inflation, and all of a sudden, the Japanese market recovered all its losses. As of now, I think the US market is doing rather nicely, thank you very much, because there's good inflation numbers again. And so if you were trading on that stuff, you'd probably be down 12% and desperately unhappy.
It's also, to maintain your sanity, you have to have a few rules to live by because things are moving so quickly at the moment. We've heard about how volatility indices, the volatility index has been quite high at the moment. In other words, what you're suggesting is that you need to look at the history. What does the history show us?
The history shows us always that it's incredibly difficult to predict these big market events. Almost by definition, the one phrase coined by that author Nassim Taleb was the black swan. The big surprise event that will cause major ructions in markets. Unfortunately, the black swan by definition is something no one predicts. So if the market were to fall over now because of a recession in America, it would be reasonably well predicted, reasonably well forecast. And so that's not going to be the thing that takes us out. It's going to be something that no one's talking about right now. And if that's the reality, then my comment will be, don't try to make money or avoid losses by trying to predict the unpredictable. The truth is, if you stay invested in the stock markets for long periods of time, you're most likely to make very good money by simply being patient. And it's the one superpower that most institutional investors, most professional investors don't have. They don't have the luxury that an ordinary investor has, which is to say, I'm going to put money in, kind of going to forget about it for the next decade or two, and I'm going to look at it again once I need the money, and not try and anticipate everything. And it's the anticipation of events that causes everybody, professionals and and amateurs alike, to really lose money. And that's my first one: is stay invested. That's your superpower. It's the advantage you've got over everybody else.
Aren't you asking for quite a lot of head when your heart is pumping very wildly? You look at this, I'm reminded of people's stories I heard anecdotally, I don't know if they're true, but I heard so many of them, that this person lost so much money at the beginning of the pandemic, they took everything out. If they'd left it, they would have been fine.
The pandemic was a mighty example of a black swan event, because it certainly wasn't something that any of us forecast, that this virus would come through and kind of work its way right across the world. And you're right, there were a lot of people who looked at this, made really lousy emotional decisions. It's sometimes investors, but equally business people that, suddenly cut their staff complements by 30% and retrenched bunches of people, and anticipating that, the entire world's economy would be 20, 30, 40% smaller than it was before the pandemic. And it's kind of maybe a year to 18 months after that we saw a major run up in world markets, kind of in complete difference to what actually was forecast. So I think the truth is we as human beings are really well designed to survive, kind of emotional events, but we're really badly designed to make long-term, sensible, calm, calculated, rational decisions.
What's wrong with trying to time the market? I mean, you get a sense of something, or you think, well, actually, this time I'm going to be active and I'm going to invest in something that surely is going to do well. Why is that bad?
The problem with market timing is we for every sensible investment decision we think we're going to make, which is I'm going to buy low and I'm going to sell this investment, when it's gone up in price and then make some profits, you're actually making three decisions. So you have to be perfectly accurate 3 times in a row. The first decision is you need to buy the investment when it's at a low price, when everyone else, for some reason, can't see the value and they decide that it doesn't have value. So you're the only person, or one of the only few geniuses out there that can see that this thing, whatever it is you've decided to buy, is actually worth a lot more than the whole market is deciding to pay for it. So that's decision 1. Decision 2 is you've got to then wait for its price to rise and be clever enough to sell before it falls over again. So you've got to be one of the first to say, okay, this is like musical chairs. I'm out now. I'm not going to be left without a chair. So you take the decision to sell. Now, most people think that's the whole reality of market timing, but it's not. It's the third decision you've got to make. Is you can't just sit there on the sidelines with cash for the next 2 decades. That's a really bad decision. So now you have to buy again after the investments have fallen, but before they've recovered again. So every time you're making a market timing call, you have to make 3 great decisions in a row. And I think, Stephen, we can pretty much get it right to sell something once it's become a bit expensive. We can, maybe that's a skill we can develop, but what we can't do as humanity, forget about any individual, is we can't make the last decision very accurately. People, professionals, hedge funds, all of those just don't seem to get that right. So I'm going to say it's not even dangerous to time the market. It certainly is. I'm going to argue it's almost impossible.
What you're trying to do, I mean, it is betting against the market, and there's a reason why that's difficult, because the market is made up of lots of brains making decisions, and you're just one.
You're right. And over short periods of time, the market can be emotional. It can be irrational. It can swing too far. And last Monday and Tuesday in Japan were very good examples of that. But over a 5 and a 10-year period, it goes from being kind of an emotional, voting machine to a rational weighing machine. And what I mean by that is it starts to reward the businesses, because we lose sight of the fact that the stock market is not just a collection of names or symbols. It's actually a collection of mostly very high quality businesses being run by experienced management teams who are doing their level best to grow those businesses day after day, year after year, and to grow the profits. And what you're doing when you make an investment decision to buy the stock market is you're in fact investing in a bunch of, great businesses with very solid management teams, and you're aligning yourself with them to say, I believe I'm not going to use the word bet, but I'm investing my money in the belief that they will create money out of the capital I give them. They're going to grow their businesses, grow their profits, pay us more dividends over time, and I'm going to be the investor that profits from that. And that to me is a fairly sure way of making money compared to almost going to the casino, which is then market timing, which you're probably gathering. I think that's a lousy strategy. Mm.
The other issue that we shouldn't forget about, I suppose, is dividends. I mean, you get money from them too.
Yeah, and I think it's something we tend to forget when we hear on the news that they've the index is up, so the index has gone from whatever it is 79,000 to 80,100 today. What that's telling you is about the price. The price of the shares in the stock market index have gone up over the day, and we think that that's what the market's actually about, but that's not true. Sometimes, over a decade or two, almost half of your growth from being a stock market investor will be earning the dividends that those companies are paying and then reinvesting those dividends into the very same shares that you own. So you actually use cash generated by the companies to buy more shares. And so you accelerate the power of the compound growth of your money. Now, if you're timing the market, if you're chopping and changing and sometimes buying and sometimes sitting on the sidelines, what you're actually doing is limiting half of the superpower of compound growth of markets, which is reinvesting the dividends, because if you're sitting on the sidelines, you're not a shareholder, therefore you don't earn the dividends. And I think it's something people tend to lose sight of, is even when markets are down, if your companies are paying you a dividend, you can use that cash flow to buy the same shares, maybe at an even lower price than you paid, which is, to me, sounds like a sell. It sounds like a good deal.
I mean, I suppose really it's also a lesson in patience. You're going to get something. You don't need to worry about it.
Yeah, and I think it's, you need to kind of take this thing as a concept, the market, and we often talk about, it's this as if it's just this, a ticker or a game, that people are playing, and when you buy the market, I'm a big fan of buying the whole market. I don't think I've got any particular skill to choose 5 or 10 shares out of the entire market and think that those are going to be the ones that are going to do well. I prefer to buy lots of companies that I think are good quality. But the reality is, if you're buying in South Africa, you need to look at it and say, actually, what I'm owning when I own, the whole of South African market is I actually own some Shoprite, and I own some Mr. Price and some Standard Bank and some Absa and Old Mutual and Santam, et cetera, and understand that, we've got some serious management teams here that are really battle tested, and allowing those businesses to deliver. Kind of, if you realize that, then maybe it makes it a bit more easy and more tolerable to own them when the prices are going down, because you're still shopping, you're still banking, you're still insuring your car, hopefully, in which case you're still a customer and you're still benefiting from all the other customers if you're a shareholder.
We're talking to Warren Ingram in your personal finance slot tonight, co-founder of Galileo Capital. In a moment, we'll hear his answer to this. We've got a question from Tuso that came through this week. It goes like this. Dear Warren, I'm going to be receiving an annual salary increase. I was wondering how best to use the extra money I'll have available. I've got a bond in my apartment, also a vehicle finance. I would like to be debt-free one day. Should I allocate the extra amount to my bond or to my finance? I suppose, Warren, it's a question about the bigger amount or the lesser amount. We'll hear Warren's answer in just a moment. Warren, of course, co-founder of Galileo Capital. Warren, we were hearing Tuso's question. He's getting a salary increase. He's got a bond on his apartment. He's also got vehicle finance. He wants to know, should he put the extra money in his bond or in his vehicle finance? I suppose it's a question about the big debt or the smaller debt.
Stephen, Tuso is a person after my own heart. I love the question because there wasn't anything about, I'm going to take some of that money to spend it on, a holiday or a big meal or something. It was all about the debt. So I feel like kind of a big responsibility here to give a good idea. My suggestion is, to look at the interest rates that you're being charged on your apartment, on the debt on your apartment, and then the interest rate that you're being charged on your vehicle. Most likely, I can't think of many instances where the vehicle finance will be cheaper than the debt on your home loan. But if it is, then rather pay off your apartment first. But if as I suspect that your vehicle finance is more expensive, then that's the one that you use to kind of knock down first. So that's where you pay off extra money first, and then hopefully you get that vehicle paid off as fast as possible, and then take all of that money that you've been putting into the vehicle and put that into the bond. And then you kind of, you get that space in your budget where you're paying off a very high rate of interest on a vehicle, and it's costing you a lot of money, compounding against you, and now you turn that around and pay that into the bond, which might be at a much lower interest rate. I often see vehicle finance at sort of prime plus 2 or prime plus 3, and sometimes people are only paying prime or prime minus a half on an apartment or on a property, in which case that's the much better thing to kind of delay paying off and pay off the most expensive assets first.
So I hear that, Warren. Just to come back a little bit, if I may, if you are at the beginning of a housing bond, and it's a much longer term debt, could it not be that actually it would save you more money in the longer run by paying as much as you can into that first? It sort of intuitively it feels like that, Stephen. But the thing is, you're looking at the thing that costs you the most. So if you work out the difference of an interest rate of 3 or 4% more than let's say on the vehicle than on the house,
paying off extra money into the house certainly will make a dent, and it will help you. I mean, it's never a bad idea to pay off debt, more quickly than you're supposed to. But the kind of straight number calculation would say that you would make a much bigger dent much faster in the more expensive debt than you will in the home loan. And also remember that your vehicle finance hopefully is not over very long periods of time. I have seen some instances where people are financing cars over 6 or 7 years, and that's a horror story for me. But if it's over 3 years and you're paying extra into the car debt, and it's only a 3-year period, you make a huge impact on paying some extra. So I do think that the car will work better. But having said that, some people feel much more comfortable, and in sort of, sleep at night factor by paying more off into their home loan. And, who are we to stop them doing that if they think that's a better idea? And maybe the last option is you don't have to do the one or the other. If you don't like my maths, by all means take the increase and put half into the bond and half into the car debt. And maybe that settles your mind if you don't like the one or the other.
I have to say, I think I would just feel that I'm not achieving anything, even though I am, if I were to split it down the middle. But I hear the point. It's a good point. Just the whole issue of, timing the market versus staying in the market. You're very much about staying in the market. There are always going to be those periods of volatility. And I think the big concern is, and this is what happened during the pandemic, that you might end up having to take your money out for some reason, at a very, very bad time. So then, do you just have to stay the course? I mean, in the end, this is all about just staying the course for a very long time and staying according to your plan, not what the markets do so much.
Yeah, I think the one thing to remember about markets is, it doesn't take an event like the pandemic to cause markets to go down. In almost every year, every calendar year, there is a time when the stock market will be down 10% over that year, sometime in that year. So you'll start the year at 80,000. At some point, it could be, down at 71,000, which, if my maths is right, that's more than 10%. And all of us will feel much poorer when that's happening, and we'll be really grumpy. And if you were listening to me and you were staying invested and you kind of had that ride down, you probably want to send me some hate mail. I think my email address is, stephengrootes@gmail.com. But don't do anything. Don't react to that. The thing is, markets tend to recover those big losses in a short period of time, and so get used to those up and down periods, and then prepare yourself to stay the course. The truth is, you can't then invest money that you think you might need in the next 1 or 2 or 3 years. You can only commit money to markets that you are prepared to leave for 5 or 10 years. And I'm joking about the email address for those that are listening. Sorry, Stephen.
No, quite all right. It's interesting though. I think over the next little while, we're all going to have to listen to our head very hard and try and ignore our heart, Warren, because over the next couple of days, we've got those inflation figures from the US tomorrow, but things are going to be a little bit seesaw, up and down.
Absolutely. And, the US election noise is ramping up, and, there is kind of increasing, discomfort about what's going on in the Middle East. Will we see a kind of escalating war there? And all of those are reasons to be fearful. My comment is, if you are invested already, then stay invested and don't pull out of your investments when those things happen, because they're unlikely to end the stock markets. They're unlikely to end the businesses that you own. So remain invested. However, if you've got cash and the markets do fall over in that time, they're down 10 or 12%, then you should do what everyone else won't be doing. You should run. It's the equivalent of running into the burning building. Go and buy when the markets are down, because actually the markets are on sale, and you should be filling your boots.
Warren Ingram, thanks very much indeed. Really appreciate it. Co-founder of Galileo Capital with Personal Finance tonight.
The Money Show with Stephen Grootes is brought to you by Absa CIB, recognized at the Financial Mail Top Analyst Awards 2024 for investment insights that put clients first. Absa